The purpose of this video is to describe what mature planning and performance management processes look like. And this also includes target setting, resource allocation, and planning, forecasting, performance management. And we're going to be looking at some specific processes. You can see the ones on the screen: scenario planning, cash flow forecasting. And if you look at a lot of the articles that are out there on the internet and in various blogs, that kind of thing, you'll hear a lot of different versions and perspectives on what maturity looks like and what fully integrated looks like. So one of the things that we're going to be examining as well is how does a data-driven process improve these different processes, and what do they look like? And when we're talking about data-driven processes, we're going to be talking as well about things like integrated business planning. So this is something that a lot of companies are pursuing these days, but not just integrated business planning. We want to talk about integrated business planning as it relates to other processes like rolling forecasts, cash flow forecasting. And one of the points of view that we have here is that sales and operations planning, integrated business planning, and rolling forecasts are really the same process. Cash flow forecasting is really just an output of that process, and that the scenarios that you have should really be something that cover the entire set of processes. And one of the things you'll also observe in the on the internet in terms of the articles is that there's a whole bunch of integration terms used out there. So what we want to do is look at it more holistically and look at what would an integrated process look like that incorporated all these different ideas. And when they're fully integrated, one of the things that we believe is that when you're hitting on all cylinders and that you've got a mature process, that strategies and cost structures should quickly self-adjust to changing market conditions and priorities to optimize both financial and non-financial outcomes. So, like I say, your cost structure should really just be more dynamic. And another way of describing this is having really kind of dynamic performance optimization. So this dynamic performance optimization really is going to be one of the lenses through which that we look at the maturity levels. So with that, we're really going to start off and say, well, what do these processes really look like? And when we go through this, one of the things you're going to find is that we're going to try and describe this in layman's terms and not get terribly technical. So as you can see, that there's a number of characteristics that we're going to be looking at, and we'll just go through them one by one. So the first is that relates to the monthly process. And the point here is that finance and operations really have one process with one cadence. And this process is collapsed through integration in sufficient time to have time for scenario planning. So one of the problems that companies experience as they get bigger and more complex is that they can't get through a rolling forecast and a sales and operations planning process in the same month. If you can't do that, it's telling you that you're not integrated. And that's a big problem for a lot of companies as they get more complex. And as we go through the rest of these different characteristics, these are really symptomatic of not having one of the reasons why you're not able to get through it in a single month. The next thing is having integrated scenarios. And what we mean by an integrated scenarios is that they should be quick, end to end, and without any interruptions. So what should happen is that you should be able to simultaneously quantify both financial and operational resources while also exposing risks, and that you shouldn't have any fragmented models or processes that cause any interruptions in the scenario at all. And this is an issue where you're using a sales and operations planning tool and maybe a financial planning tool. So you might do part of the scenario in a sales and operations planning tool, hand it off to a financial tool, and you may have a bunch of spreadsheets in the middle. The bottom line is that, getting through a scenario is not a trivial undertaking, and that what you should be able to do is get through any number of scenarios that you want in a very short period of time, as opposed to getting through a couple over a longer time. So one of the other things that helps with this is having an optimization tool that can cover the entire company, not just supply chain. And, another term for this would be like prescriptive analytics. So you should have a prescriptive analytics tool that can support both finance and operations. So the next issue is cash flow. And cash flow should really just be an output of an integrated process. And the reason why this is a problem, if you look at a lot of companies have implemented financial and sales and operations planning tools, their cash flow forecasting is terribly inaccurate. And that goes along with, if you're looking at cash flow, you should also have foreign currency exposure and working capital forecasting being an output of the process as well. Because one of the things when you're really got a good process, you should be simulating resource consumption, which also means that you should be simulating the balance sheet. And one of the reasons why this is so important, if you want to have a process that's focused on value, you need to focus on cash, because cash flow is a proxy for value creation. So the idea here is that if you don't have a process that can give you good cash flow information, it's not helping you drive value as much as it should. The next thing is on variance analysis. If you've got an integrated process, you should never have to be doing manual variance analysis at all. It should be automated and provide you insight into the things that comprise the variances. So it separates volume, mix, price, cost, and productivity variances. And it should be able to do this across any combination of budgets, actuals, forecasts, and scenarios. So contrasting two scenarios together, or comparing budget versus a scenario or forecast, that kind of thing. So, and if you've got all this information, you should never have any sort of performance surprises, when you're in like a monthly integrated planning process. So it may be that, the right thing to do is going to be a decision that actually is different than what your annual plan is. But, it's the right thing to do to optimize your cash, but it's throwing off variances. So you should never make these decisions without actually knowing what it's going to do and have anybody be surprised by it. The next thing that distinguishes a fully integrated process is that your monthly financial and operational plans are always automatically reconciled. So in the traditional integrated business planning process, you have this thing called integrated reconciliation. And the vast majority of times, these are very manual and very manual processes. This should never be a manual process. It should always just fall out. Likewise, one of the other things that's not the best in a lot of processes is the reconciliation between the monthly operational process and the weekly plans. So in a lot of cases, how these monthly processes are deployed into weekly planning processes, again, tends to be terribly manual and not always reconciled. And what should happen is you should have the ability to translate your monthly process down and have a mechanism that tells you what's the right way to allocate different parts of the plan into different weekly buckets, and have the intelligence to have some sort of latitude in terms of how the decisions are made as to how the monthly process will be deployed into a weekly plan, and kind of likewise with strategy in the monthly plan. Now, again, everything that we've talked about it as well to this point, the absence of the ability to do things is really symptomatic of not really having a good data-driven planning process, because it should be the data that's and the parameters and structures you put around it that make these things happen automatically. The next characteristic applies to revenue and demand. So one of the things that organizations often struggle with, manufacturers, is having separate revenue, demand, and pricing processes, when in fact these should be done simultaneously. This often happens when you're using, again, multiple systems. Like you have a financial planning tool and an operational planning tool, and the processes are fragmented. So they should be all done, like I say, all done simultaneously to collapse the cycle time. One of the other things that should happen is that you should have, different versioning that connects to different perspectives. So for example, if you, as a senior level executive, want to say, let's set a 5 or 10% target to increase sales, you should be able to do that. But what you want to be able to do is maintain that perspective while also maintaining the perspectives of other forecasts at lower levels of the organization, and articulate what the differences and assumptions are between them. And along with that, one of the things is that you should always be able to maintain plan and forecast integrity. So one of the big things here is that whenever you're doing kind of statistical forecasting, you should never go back into a statistical forecast and adjust it for things which are not forecast related. So if you want to make a planning adjustment and set a target, you should be able to do that, but you should be able to maintain the integrity of your planning, of your plans and forecasts. A couple other things which are worth highlighting here is that when you don't have an integrated process, you often have duplicate data entry. So if you see processes where there's duplicate data entry, you're probably not integrating. It's probably not a good thing. As well, one of the things that's happening is that in the software world is financial tools are getting into areas where were usually typically the domain of sales and operations planning tools, and that comes in the form of revenue and demand planning. Now, one of the weaknesses of these tools is that they don't always capture forecast adjustments without a reason code. So it's nice that you can kind of do top level adjustments and extend it down to the organization. If you do this without reason codes, when you're really trying to capture or make an adjustment because of some forecast insight, you're really not improving your forecasting ability at all. And lastly, one of the biggest problems when you have fragmented processes is that forecasting or collaborative forecasting is different to do, because what should happen is that you should be able to run a collaborative forecasting process in any unit of measure and at any level of aggregation. So if you want to forecast in dollars, you can do that. You can forecast in kilos, or you can forecast in pallets, or whatever measure you want to have. You should be able to do that. And these are kind of classic weaknesses of a lot of tools that really aren't that integrated or all that mature. Next one is planning models. Finance and operations should share one planning model. And many people refer to this as kind of like a digital twin, something that really helps you articulate how the economics of your business from both a financial and operational perspective. And these models should extend to the entire organization. And I say this because one of the biggest challenges is that, the supply chain tools, often have models that allow you to model maybe 50 to 60% of the business, when in fact you need something sophisticated enough to model 90% of the business. And this is an issue because most financial planning tools are not that sophisticated. They really have fairly weak planning capabilities. While it might be fine for forecasting from a financial reporting perspective, they're really not all that operationally realistic in many cases. And one thing I alluded to before, that as part of this model, finance and operations should share the same prescriptive analytics model. And this gets really important in different areas within finance. So for example, treasury, tax should both be able to use the same prescriptive analytics model to support whatever analysis they're trying to do. So you really shouldn't have multiple prescriptive analytics models. You really need to have one that has the structures to pull everything together. And again, this is another indication of what do you mean by data-driven organization. If your structures aren't strong enough to support one model, that's going to be a problem for you. The next relates to the development of automated aggregate models. And in supply planning, one of the things that happens in supply planning is that you may have millions of products, but if you're an executive, you don't want to be planning at millions of products. You want to roll it up into some sort of product families, something that allows you to get your arms around the business. So you may roll 1 million products up into 500, and you should be able to aggregate and disaggregate down the hierarchies. Now, the interesting thing that happens when you've got a really good data-driven approach, this same mechanism should drive the automatic development of your financial models. So what this means from a finance perspective, in most companies, finance are developing these things manually. It's very difficult to keep them in sync and keep them accurate. So if you look at ways to kind of improve the efficiency of finance, this is a really big one, because it essentially eliminates the entire activity of maintaining financial models. And lastly, again, the same kind of aggregation and disaggregation should be the thing that helps you integrate strategy into your plans, because it allows you to connect the outcomes that you're trying to produce, both from an operational perspective and a financial perspective, into the processes that enable those outcomes. The next issue relates to exposing assumptions. In a lot of cases, what you'll find is that tools will allow you to make assumptions and put them in cells. The thing is that these are really hidden from a financial planning perspective, and they're often static. When really what these things are measures that should be used as part of your planning system, and really are kind of planning parameters. And when you don't have these things exposed, it gets really difficult to connect upstream and downstream activities. And what another way of saying this is really kind of having a dynamic model that can translate, say, how an increase in demand affects something way down the line in your supply chain. Now, this is kind of one of the primary reasons why companies have surprises, is that their models aren't flexible enough to handle this. So exposing those assumptions and integrating measurement is really important. Now, one other thing here that is really important to note if you're trying to look at characteristics of integrated tools and processes, is that you should never have spreadsheets in your process at all. Because when you have spreadsheets, it means that your planning and measurement processes are fragmented, and that you really don't have mature enough platforms, workflows, and models to eliminate them. And what this leads to is disconnected financial and operational processes. So anytime, as an executive, if you're trying to drive a process or process design that's going to be fully integrated, one of the things that you can express is, I don't want to see one spreadsheet in this at all, or at least have a path to getting to no spreadsheets. And that's an important thing, because most tools don't support that. The next thing is what it relates to new products. And the thing here is that one of the areas where companies get into difficulty often happens in the product development process, where you design products that may or may not be as profitable as you think. So one of the things you want to be able to have are planning models that can evolve with product development, and these different versions of these models can be used to quantify the impact of these new products on all aspects of the business. And that these valuations of what these products are worth can vary with market changes. So the one thing, if you're looking at, sort of a key characteristics of a process that will really drive value, you should be able to know, if you're a global company and introducing a product globally, how will this new product affect my capacity, my cash flow, my foreign currency exposure, working capital? You should be able to have that at your fingertips. So this is And this should be embedded as part of your rolling forecast process. The next thing, which is characteristics of a mature process, is that you should really never have to do kind of manual cost reduction projects. One of the things that should come out of this process as a byproduct should be places where you can either reduce activity volume, eliminate non-value-add activities, or identify activities where you're providing excessive service levels. So these things should be things that are again, part of the overall process. Now, extending that a little bit. So one of the things that, as you identify these cost reduction opportunities, it should give you an understanding of the potential projects to achieve the various cost reduction opportunities. So you might be able to group different opportunities into potential projects. But the thing is, the tool ought to be telling you how, given the current economics of your business with the volume and mix that you have, what's the value of these potential projects? And these things should be automatically calculated. Now, this also includes, when you look at portfolio value, looking at the value of your customer and product portfolio. So as you look at your product portfolio, you should be able to understand which products may be heading into areas where they're not as profitable as they once were. So these sorts of insights should be kind of byproducts of your plan, your integrated planning process. And lastly, these processes should support both the entity as a whole and business units. And one of the biggest problems that companies have when you have fragmented tools is that, say, you go through a sales and operations planning process, you do your demand, balance supply, then throw the results of that into a rolling forecast process, come out with something, and then you may do that across multiple companies, roll it up. And then you get to corporate and, let's say your CFO or somebody at a high level says, well, I want to look at our, let's say our building product segment. I want to know if volume goes up or down by 5%, how's that going to affect our business? And I want to do that horizontally across multiple legal entities and then roll it up. This is a place where companies really get stuck because there is no tool to do this. So if you want to execute these market-based scenarios globally, it gets really difficult. And then not only that, once you've conducted the scenario, you want to be able to quickly deploy that back into your legal entities. And that gets really difficult to do when you have multiple applications. And as you're doing that, you're looking at these scenarios, you want to be able to quickly reset the targets and reallocate resources. Again, the processes really aren't there. So if you look at what companies just went through with COVID-19, this is exactly what the problem is that you've got these multiple tools that really don't speak to one another very well. You really don't have a common understanding of the economics of your business. Now, lastly, all of these things kind of roll up into this kind of one thing. So if you're a senior executive watching this, this is one thing that would be worth paying attention to, because collectively, all of these things enable one mechanism that most companies don't have, which is a formal mechanism for optimizing value. And let me explain this. So in sales and operations planning, one of the things that is always talked about when you think about sales and operations planning is managing inventory investment versus service level. So this is a form of a trade-off that most people are fairly familiar with. When companies think about integrated business planning and extending it to the organization as a whole, there is no similar mechanism to manage these trade-offs. It doesn't exist. So in other words, if you're not able to manage these trade-offs, you really don't have a mechanism for planning and managing the outcomes that comprise your strategy. And some companies or software companies will tell you that they do optimization, but if you have one, you should be able to point to a specific screen and say, show me the screen that allows people to plan, manage, and govern various outcomes and related trade-offs. That's a big disconnect in most applications. It's not, you won't find it in kind of financial tools, and you don't see it in sales and operations planning tools. So if you wanted to look at one specific thing that you're looking for, that's going to really drive performance improvements through like a data-driven approach that brings finance and operations together, this is it. Now, there's some implications of not having this. So if you look at this screen here, this shows you the various research studies that show the impact of not having this. So ultimately, one of the things, if you look at all these different research studies, what's common to all of these different, the value erosion depicted in these research studies is companies lack an ability to plan and manage and govern outcomes and trade-offs across functions and entities. In other words, and this is leading to a cost of complexity. So the absence of this capability in most systems is what's leading to this. So if you want to know more about this, the research studies that underlie this, there's a separate video that I have that on the IBP Collaborative site that will tell you about this. So just to kind of summarize, what do mature processes look like? Hopefully we've kind of given you some ideas as to what you should be looking for. Hopefully most of these were in terms that, that were not too technical, to help you kind of visualize what you ought to be looking for, and as well give you an idea of what does a mature process look like in fairly simplistic terms. So if you have any other questions or comments about this, please feel free to use the contact information on the screen.